Number one, you'll obviously filter the day type. Importantly, this is not for sideways, choppy price action. You want a clear trend day with prices near the lows in the final 15 minutes. Number two, you'll mark key levels. So you'll mark the previous day's low, intraday support, or a clear consolidation floor that has just been broken. Number three, you'll wait for a simple trigger, and you don't need anything fancy for this. For example, a break and retest of a key level, price breaks the low, pulls back, fails, and then starts to roll over again. Or a small failed bounce in the last 15 minutes, a spike up that is immediately sold into. You'll enter short as that failure confirms with your stop above the recent swing high or above the broken level. And of course, your target will be the closing bell. This is a true scalp. You're not trying to capture the entire trend. You're simply trying to capture those last 15 minutes and the urgency that the institutions and hedge managers are putting on that trade. Hi, I'm Ali from FX Scouts. Now, have you ever stared at the markets all day only to realize that the real action happened in the last hour of the day? If you only have a small window to focus on each day, you're a part-time trader, then the last hour can be a really powerful time to focus on. That final hour is often where big funds rush to make their final moves, where trends either accelerate or collapse completely, and also a time where you can position yourself for multi-day moves. In this video, I'm going to show you two practical ways to trade the close. Number one is a scalp strategy for the last 15 minutes on big trend days, and number two is a VWAP Magnet strategy that really works well. So why does the close matter? Even though most of us trade Forex and CFDs where prices basically move around the clock, the open and close make a difference to what happens with this price action. For example, the US equity session closes at 4 p.m. Eastern, and when that bell rings, a few important things happen. Number one, big funds and institutions need to finish their business. If they've been instructed to buy or sell a large volume today, they cannot simply finish it tomorrow without changing their mandate. Number two, many options and other derivatives stop trading, which changes how market makers hedge. Then after hours trading does exist, but liquidity is much lower and the spreads are much higher, and therefore the big players don't really want to trade during that time. And what happens is that these last 15 minutes of the session often creates urgency. It's get it done now behavior. We also find big supply and demand imbalances, which means that price stretches further than it would in the normal trading day. And lastly, you have clear intraday structure. By the close, you can see whether the day was a trend, a range, or a failed breakout. Now, our job as traders is not to try and predict every tick. Our job is to recognize patterns. And of course, we don't know what will happen next, but we have a good idea of what might happen. We can then define our risk very clearly. And of course, there's reasonable upside edge if we are right. So I just want to give you two different strategies for trading the close. The first is the 15-minute scalp at the end of the day. So this is an aggressive short-term trading strategy that, as I said, focuses on the last 15 minutes of the day. And it's really designed for strong trend days, especially heavy down days on indices or large cap stocks or equivalent index CFDs. So for example, think of a day where the market has been selling off during the whole session. Here you see price opened, it tried to rally a bit and then has just been grinding lower. The instrument is the bottom 20% of the day's range as you head into the final 15 minutes. You see that key support levels have already broken, and you find that volume is higher than normal, and the news flow is also bearish. Now, if you put yourself in the shoes of a fund manager or an algorithm, what you'll find is that they've probably sold off 90% of their assets, and it's the last 15 minutes, and they have to sell that last 10%. So there's a lot of urgency in the trade. If you are a fund manager, are you relaxed, or now are you speeding up to try fulfill your mandate? You're probably speeding up. And what happens with institutional algorithms as well is that they start to get more aggressive towards the end of the day to try and close up their orders. And they're not worried about price at this point. They're just worried about making sure that they fulfill that close. And for us as retail traders, that urgency can create a final flash in the direction of the trend. So how do you trade it? Number one, you'll obviously filter the day type. Importantly, this is not for sideways, choppy price action. You want a clear trend day with prices near the lows in the final 15 minutes. Number two, you'll mark key levels. So you'll mark the previous day's low, intraday support, or a clear consolidation floor that has just been broken. Number 3, you'll wait for a simple trigger, and you don't need anything fancy for this. For example, a break and retest of a key level, price breaks the low, pulls back, fails, and then starts to roll over again. Or a small failed bounce in the last 15 minutes, a spike up that is immediately sold into. You'll enter short as that failure confirms with your stop above the recent swing high or above the broken level. And of course, your target will be the closing bell. This is a true scalp. You're not trying to capture the entire trend. You're simply trying to capture those last 15 minutes and the urgency that the institutions and hedge managers are putting on that trade. Now, this strategy really forces you to practice discipline. You don't want to be meddling with the trade every 30 seconds. Either you get stopped out, or you allow your trade to run to the closing bell. Now, this strategy obviously works well on trend days, but what happens when we've got those mean reversion days where price is basically bouncing up and down between support and resistance? That's where the next strategy comes in. The next strategy is one of my favorites. It's the VWAP Magnet trade. VWAP stands for volume weighted average price, and many institutions use VWAP as a benchmark to decide how good the execution was for the day, whether they got the price they wanted. On rotational range-bound days, what you'll find is that price oscillates up and down above and below the VWAP. And you'll also find that VWAP is relatively flat. There's no strong one-sided order flow pushing price away for hours at a time. And in that environment, VWAP often acts as a magnet. So when price stretches too far away from the mean, it will often snap back because traders are seeing a certain price as too expensive or too cheap, depending on which level it's on. And we can also use this behavior very effectively in the last hour. So how do you identify this? Number 1, you're going to look for an instrument that has been choppy all day, that's not really trending. Number 2, you'll look for an instrument where price has been trading up and down, snapping back to the VWAP. You want to see that the VWAP is roughly flat. And in the final hour, you want to see price clearly away from the VWAP into a prior support or resistance area. And this is the trade idea. So, for example, you're going to identify the extension. If you see here, price is now well above VWAP and pushing into a clear resistance. You then going to wait for a reversal signal. This could be a pin bar rejecting the level, a small double top, or a strong engulfing candle back towards VWAP. Then you'll enter or fade the move back to the VWAP. So if price is extended above VWAP and you see a clear rejection, you consider a short with a stop above the recent high and a target at or just before VWAP. Because we are trading late in the day and it's a rotational day, because price has moved far away from VWAP, we expect a snap back to VWAP before the close. Now, this is not a home run strategy like the scalping strategy. You're probably not going to make as much profit as you would on a clear trending day, but you'll probably find that these trades work out more often than not. You also need to tell yourself that if the day is choppy, I do not trade unless price is clearly stretched away from VWAP and gives me a reversal signal in that last hour. And that one simple rule can really keep you out of low probability trades. So when don't you trade these? Well, there are a few rules. So both strategies have one thing in common. They start out with very clearly defined conditions. Some days the close will not offer a clean trend day, or it won't offer a day where you're finding price moving away and snapping back to the VWAP. And on those days, of course, the most professional thing you can do is sit on your hands. Don't trade at all. If you had to go through your journal and take away all the boredom trades where you traded at random because you felt that you had to trade, you'd probably see a massive improvement in your results. Your edge comes from being selective, not from being active. So you want to use the close as a structured window. Prepare, scan for these scenarios, and if they're not there, carry on with your preparation and practice discipline. So as a recap, we've spoken about scalping the last 15 minutes on big trend days, especially to catch that final wave of institutional urgency. And secondly, we spoke about using the VWAP magnets on rotational days to avoid getting chopped up and only trading stretches back to the VWAP. Thank you so much for watching. If you found this video helpful, please give us a thumbs up. And if you're not already, please subscribe to our channel. And I will see you in the next video.